Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
Let's just take a moment. Think about the future of defense. We're talking sleek, autonomous drones, titanium skins, hypersonic missiles that can outrun, well, anything piloted by a human. These machines aren't just about advanced software. Their real strength, the invisible core, comes from the metals holding them together under incredible stress. They represent the absolute edge in future conflicts. Robots, smart weapons. They're changing everything. But here's the crucial part, the key insight for you as you learn about this space. The specialty alloys they need, the ones that have to withstand, say, 2,000 degrees Fahrenheit, intense corrosion, massive impacts. Often they trace back to one American company, a company that's actually 136 years old. And with global defense spending now soaring past $900 billion a year, driven by all this geopolitical tension, you have to ask the essential question: are the proprietary alloys from Carpenter technology truly the non-negotiable, unbreakable backbone for tomorrow's robots and weapons? That's our mission today. To figure out if betting on this supplier means riding a powerful geopolitical wave, or if this is maybe just a temporary market mirage.
That's a perfect way to frame it. Because, the company's own story is really one of survival, of transformation. Its resilience, this sort of metallurgical grit, it started way back, 1889 in Pennsylvania.
That's right, James Henry Carpenter. He started it to make steel for, believe it or not, railroad axles. A totally different world from today's hypersonic alloy.
Completely different.
But that early start showed its survival instinct right away. It had to survive the panic of 1893, which was devastating. And then, incredibly, it even went into receivership in 1903.
And that's what's so instructive about the history, isn't it? That early struggle kind of foreshadows the adaptability that really defines its success now. It learned very early how to pivot. It bounced back from those huge early hits by shifting focus. Suddenly, it was making tool steels for World War I artillery shells. That pivot really set the stage for its defense focus, building a relationship with the Department of Defense that's just deepened over the last century.
And the strategic moves just kept coming.
Absolutely. Think about after World War II. That's when they developed AirMet 100, a genuinely groundbreaking miraging steel. This wasn't just metal. It was a performance multiplier.
Right.
It allowed F-15 fighter jets to use gun barrels that could handle 100,000 rounds. That level of durability, that heat resistance, that it was unheard of before. Then later, in the 90s, acquiring Tally brought in crucial titanium expertise, essential for stealth bombers, high-speed aircraft.
So the company has effectively reinvented itself multiple
At
times.
least 3 major times, yeah. And each pivot strategically strengthened its position just as defense spending started climbing globally.
Which brings us right up to today and the leadership team that drove this latest, really aggressive strategic shift towards defense. Tony Arthine, chairman, president, and CEO since 2015. He's a material science guy through and through, and he saw they had to move away from those low-margin commodity steels.
The Denied's pivot is, well, arguably the most critical one in their recent history. He understood that trying to compete on price for standard steel was just a losing proposition. So he shifted the focus, shifted the capital towards high-performance alloys. Nickel, cobalt.
The really specialized stuff.
Exactly. Not commodities. These are custom-designed ingredients, absolutely essential for things like robotic actuators, advanced missile casings, materials that have to endure maybe 2,000 degrees Fahrenheit without failing, without warping, cracking, just failing.
And the financial impact of that shift.
Oh, it was huge and positive. Concentrating on these defense-critical innovations pushed their aerospace and defense revenue to over 60% of total sales by full year 2025. That move really changed them from being just another cyclical steel company, vulnerable to economic swings, into this essential, almost locked-in supplier for weapons programs that run for decades.
And importantly, his incentives seem directly aligned with investor interests. You mentioned he holds over 100,000 shares personally.
That's right. And his performance-based stock grants, they only vest if the company gets pretty aggressive growth targets. Things like return on invested capital, earnings per share goals, specifically linked to that defense sector growth. It really mirrors the kind of performance they achieved, like that 21.5% return on equity in full year 2025.
That personal stake backed by serious investment, like the 2025 expansion, that $400 million melt facility in Pennsylvania.
Right. And that wasn't just routine spending. That was building capacity specifically for tomorrow's kind of warfare. That facility directly targets the booming demand for the super-refined alloys used in autonomous weapon systems, where every ounce saved, every bit of added strength translates directly into drones that can fly further, stay up longer, and outmaneuver anything else out there.
And the effect on the bottom line, can we see it there?
The results really prove the strategy worked. A 48% jump year-over-year in operating income, reaching $525.4 million in full year 2025. That surge was overwhelmingly driven by those defense and aerospace contracts. It shows the pivot is generating really significant returns on the capital they invested.
We should also touch on the operational side. Brian K. Malloy, promoted to president and COO in 2025. He seems key in making the production side run smoothly.
He's absolutely the operational linchpin. His background was critical in optimizing their internal supply chains, especially for the titanium powder needed for 3D printed drone parts.
Which is a huge growth area.
Huge. And think about the speed needed in defense. Every hour counts. Malloy's work helped cut critical lead times by about 25%. That means faster prototyping, faster delivery on those really lucrative high-specification Pentagon contracts. It gives them a real time-to-market edge against competitors.
So their combined expertise, metallurgy plus operations, feeds into a strategy that's just laser-focused on the materials for tomorrow's weapons. Their mission statement reflects this, that to collaborate, to build a better future by developing better materials and smarter processes that transform capabilities, that feels like more than just corporate speak.
It really acts like a clear mandate, a battle cry almost, for alloys that fundamentally change defense tech. And the vision is just as direct. Global leadership in premium specialty alloys for extreme challenges, specifically targeting growth areas like electrification, additive manufacturing, all within weapon systems.
And it's backed by significant brainpower. Over 200 metallurgists focused on innovation.
Yeah, across a huge range of applications, too, from materials for the Mars rover to, obviously, next-gen drone tech.
That culture seems to deliver tangible results for investors. You mentioned 16 straight quarters of margin expansion.
Yes, that kind of consistency speaks volumes. Their whole ethos pushes innovation. It leads to things like the R&D into nitinol-shaped memory wires. We'll talk more about those for potentially self-healing robot joints. Or developing cobalt-free alloys to cut costs in mass-produced robotic munitions. This focus on extreme ownership, as they call it, ensures every piece of metal, every powder granule aligns with that vision of their alloys being the backbone of future defense tech.
Okay, so if that strong leadership is the driving force, the proprietary alloys themselves are what create that market protection, that moat around the business. For listeners who are material scientists, how can we grasp the core business model here without getting lost in the metallurgy?
Well, in simple terms, their model is pretty direct. They melt specific raw materials, forge them into shapes, and distribute these highly specialized alloys. Think of them as the master blacksmith crafting the armor for a very advanced, very powerful robot. They supply the super strong metals, things like custom 465 stainless for missile bodies, or pyromet titanium for drone skeletons, which the big defense contractors, the OEMs, then shape and build into the final weapon systems. Now, the really critical technical detail, the thing that sets them apart, is their process control. They rely heavily on vacuum induction melting, VIM for short. This happens in a near vacuum, getting rid of almost all oxygen and nitrogen. Why is that vital? Well, just like a computer chip needs ultra-pure silicon to work fast, these extreme alloys need near-perfect atomic consistency.
Okay.
If an alloy in, say, a railgun barrel had even a tiny impurity from standard melting methods, it could fail catastrophically when fired. VIM ensures the chemical mix is controlled down to the parts per million level. It prevents those potentially deadly weak spots.
That makes sense. So the simplicity of the model, unique materials, predictable demand from defense contracts, it really suggests these aren't just commodities. They're more like irreplaceable links in the chain for future robotic warfare. But what really sets them apart from competitors who also make specialty metals, someone like Aperam, for instance? You mentioned a triple intersection of uniqueness that creates this strong barrier.
That's really the heart of the investment case. First, as you said, it's the proprietary alloys. They are genuinely best-in-class materials. Take Aeromet again. Its unique internal structure makes penetrator warheads something like 10 times tougher than competing materials. They aren't just selling metal, they're selling a measurable performance edge.
Okay, performance edge first. What's second?
Second, that unique product lineup fuels a powerful economic engine running on really significant defense margins. They consistently hit over 60% margins on some specialty product lines. In the fourth quarter of full year 2025, they reported an overall margin of 30.5%. That points to pricing power far beyond what you'd see in standard industrial metals.
And the third part of that intersection?
The third is this deep-seated culture of extreme engineering. built on more than 135 years of continuous R&D. Think about the materials they're developing just for cutting-edge systems like cobalt alloys for high-powered laser weapons. This isn't just about making metals strong, it's about thermal engineering in solid form. If the material absorbs too much heat too quickly, the laser's focusing mechanism warps, and the whole multi-million-dollar system is useless in seconds. These alloys manage heat so well, the laser can fire repeatedly under tough battlefield conditions. It's a perfect example of how their model turns geopolitical challenges and advanced defense needs into that reliable income growth we talked about.
That uniqueness really does seem to cement these alloys as the backbone for tech robots, especially since competitors often can't get the necessary defense certifications quickly. But how do they lock in that demand? How does their distribution model strengthen the moat, and what protections are there for you, the individual investor?
Their distribution is a smart hybrid B2B setup. A big chunk, about 60% of revenue, comes from direct sales. They target the Tier 1 defense, primes your Raytheons, your Lockheeds, selling large alloy billets for things like smart munitions. Then they use distributor networks to reach smaller industrial customers globally. But the really clever twist, the thing that helps lock things in, is their proprietary Alloy Advisor AI tool. It's basically a service they offer that lets defense engineers simulate how an alloy will perform in a virtual robot prototype before they even order the metal.
Ah, interesting.
Yeah, it speeds up the customer's design process, and it speeds up Carpenter's order cycle by about 20%. This direct, high-tech connection to the Pentagon and its main contractors is incredibly valuable. For instance, during the big push for Ukraine aid, this direct pipeline let them deliver 15% more titanium forgings than expected. It shows how their specialized model can scale really quickly when defense needs surge. Distribution itself becomes part of the moat.
That tight integration seems to lead directly to revenue predictability. In a sector known for ups and downs, how do they achieve that kind of financial stability?
It's pretty unusual for a materials company, you're right. The main reason is that around 70% of their revenue is recurring. It comes from long-term, multi-year defense contracts. They have a huge confirmed backlog, $500 million, just with GE for engine alloys for ongoing F-35 upgrades.
Right.
That structure smooths out the usual cycles because modern weapons programs run for decades. They need constant material supplies, regardless of what the broader economy is doing in the short term. So even though full-year 2025 saw a slight dip, about 5% in their standard industrial sales, they still delivered 21% income growth in the fourth quarter. Why? Because the strength of those pre-negotiated locked-in defense orders. That stability means predictable cash flows, which helps them weather potential downturns while still investing aggressively when spending ramps up.
And that brings us to the competitive edge from those incredibly high switching costs. I often hear those are the strongest moats for investors. How significant is that barrier in this case?
Oh, it's arguably the deepest part of their moat. Getting a new specialty alloy recertified for military use is incredibly complex. It takes years. It costs millions of dollars. You can't just swap in a cheaper alternative.
No easy substitution.
None. You have to meet exacting military specifications, mil-spec, and often FAA qualifications too, especially for drone components. This whole regulatory and testing hurdle effectively locks in about 70% of their repeat business, and it lets them command a reliable price premium, maybe around 20%, simply based on their reputation for extreme reliability. That reputation comes from track records like having 0 reported failures in F-35 turbines using their materials. That's trust you can price.
Turning to operations, that vertical integration and the fact that it's all U.S.-based seems really important strategically, both for winning defense contracts and protecting their know-how.
It's absolutely strategic. And frankly, it's a huge competitive advantage right now, given the global situation. They run a deeply integrated operation designed for defense agility. They control about 80% of their supply chain. The core melting, that VIM process, happens in Reading, Pennsylvania. That keeps critical intellectual property secure. Forging is done nearby in Latrobe, Pennsylvania. That's the facility that just got a $100 million upgrade, mainly for titanium. And the powder atomization, which is key for 3D printing, is in Washington, Pennsylvania.
So keeping it all close geographically is deliberate choice. What are the main advantages for their defense customers?
Well, there are really 3 big ones: IP security, quality assurance, and speed of response. By controlling 80% of the chain, from melting the raw nickel and cobalt right through to the finished billets, they maintain incredibly strict quality control. Their in-house vacuum arc remelting process, VAR, which is yet another step for even higher purity, gets them to 99.99% pure alloys. That's what you need for things like hypersonic missile nose cones. It not only guarantees consistency, but also cuts costs significantly, maybe 15%. compared to outsourcing these tricky, high-purity processes. Plus, keeping it all in the U.S. avoids tariff headaches for core defense materials and lets them respond incredibly fast to defense surges. Like in 2025, they delivered alloys for specialized robotic mine-clearing vehicles in weeks, not the months it might take others.
But supply chains for specialty metals always have risks, right? Especially with materials like cobalt and titanium being in such high demand. How resilient is their sourcing against global disruptions?
They've definitely built in resilience. For something critical like cobalt, they use dual sourcing, getting it from both the U.S. and Canada. That effectively sidesteps the huge geopolitical risks tied to relying only on places like the Congo. And in 2025, they very deliberately built up inventory levels. That helped buffer against inflation spikes and let them maintain a 98% on-time delivery rate to major contractors like Lockheed, even when commodity prices were all over the place.
Okay, but where's the main weak spot? The key vulnerability investors should keep an eye on.
The biggest one is probably their reliance on China for about 20% of their titanium supply. That does expose them to potential trade friction, tariff costs, maybe in the 5 to 10% range. Yeah, that's a real financial risk.
How are they managing that?
They're tackling it proactively. They've built up a significant strategic stockpile worth around $35 million. And they're also strengthening partnerships with U.S.-based recyclers to source more secondary titanium material efficiently. They're often better at this than competitors.
Let's pivot now towards the future. The company talks about a growth strategy targeting a 25% compound annual growth rate, a CAGR, through full year 2027. That sounds incredibly ambitious. What are the main things driving that projection?
The drivers are pretty fundamental, tied to global politics and technology shifts. You've got the obvious one, surging global defense budgets, already over $900 billion. Then there's the exponential growth in robotics, fueled by the boom in additive manufacturing or 3D printing. And finally, there's a strong push from governments for supply chain reshoring, bringing manufacturing back home. The company actually thinks reshoring alone could account for a full quarter of their projected growth.
Is the overall market, the total addressable market, big enough to support that kind of aggressive growth rate?
The market data suggests it is. The specific segment they play in high-performance alloys for defense is expected to grow significantly. Projections show it expanding from around $4 billion now to maybe $6 billion by 2030. Given their unique position with proprietary materials, they're aiming to capture a large slice of that growth, targeting about $900 million in defense revenue just within that specialty niche.
Of course, that growth only happens if they keep innovating. We should probably look at some specific new products that show how their R&D investment is translating into meeting future defense needs.
Definitely. Take their 2025 launch of custom 475 stainless steel. This was engineered specifically for gun barrels and autonomous turrets that need high corrosion resistance. Its improved fatigue strength means these automated systems can operate longer in harsh conditions with less maintenance. That innovation apparently boosted orders by about 15% right after launch. Or look at the rollout of Hyperco 50A soft magnetic alloys. These are critical for advanced systems like electromagnetic pulse weapons or high-speed railguns because they optimize how magnetic fields are generated and controlled. These kinds of advanced materials directly added something like $20 million to their fourth quarter income.
And looking even further out, what about that big $400 million capital expenditure? What kind of forward-looking R&D is that funding?
That capital is really fueling the next wave, materials that sound almost like science fiction. A big chunk is accelerating R&D into nitinol. That's a nickel-titanium alloy known for its shape memory property.
Shape memory?
Yeah, meaning if you deform it, applying heat makes it return to its original predetermined shape. They're engineering this for potential use in shape-shifting robot skins by full year 2027. Imagine robot parts or drone surfaces that could literally self-heal small cracks or change their aerodynamic shape on the fly. They're also putting serious money into quantum-resistant alloys, aiming for cyber-secure munitions. They're fundamentally positioning themselves to supply the materials for the intelligent, adaptive weapons of the future.
Okay, let's switch gears to the financials. For you, the individual investor listening, what do the full year 2025 results tell us about the company's current operational health?
The numbers really confirm a picture of strength and high efficiency. Full year 2025 revenue hit a record $2.88 billion. That's up 5.6% year over year, and it was fundamentally powered by that strong 60% mix from defense contracts. Crucially, they're operating very efficiently. Operating margins hit 18.2%. Return on invested capital, ROIC, was an impressive 19.9%. That shows really smart capital management, especially since they were doing those huge $400 million expansions at the same time. They're investing heavily, but still getting great returns.
And the cash situation looks exceptionally strong, almost like a fortress.
It really is a fortress balance sheet. Adjusted free cash flow, FCF, came in at $287.5 million. That's a massive 50% jump from the previous year. That cash flow gives them a huge war chest for more R&D, particularly in robotics, without needing to issue more stock. The balance sheet backs this up. $450 million in cash against only $300 million in debt. That gives them a very strong current ratio of 2.8. And the defense-specific numbers look great, too. The defense order backlog is up 20% to that $500 million mark, and their specialty alloy plants are running at high utilization, around 85%.
To give our listeners some context, how does this specialized forge, as we've called it, compare financially to others in the specialty materials field?
When you compare the numbers, the outperformance is pretty clear. Their revenue growth, that compound annual growth rate, or CAGR, was 14.4% over the last 3 years. That significantly beats a peer like Allegheny, which grew around 8% in the same time frame. And on efficiency, their 20% return on invested capital really stands out against, say, Universal Stainless's 12%. You see a strong positive trend over 3 years, too, margins improving steadily from 8% up to 13%, and return on equity holding strong near 22%. It suggests they can deliver sustained superior returns if defense spending stays on its current path.
Those figures definitely paint a positive picture. But how robust is that success? We also need to consider the risks, the potential downsides, and the company's ability to withstand shocks, its anti-fragility.
Absolutely essential to look at that. Historically, the company has proven remarkably resilient to economic shocks. Big recessions, like the one back in 2008, actually forced them to refocus and restructure, and they often emerged stronger and more efficient. You can see that in the 14% CAGR they achieved right after that downturn. And maybe counterintuitively, global conflict, like the current situation involving Ukraine, has directly boosted their defense orders by about 20%. It shows they can actually benefit from, or at least weather, geopolitical instability quite well.
Given that resilience, what are the main risks that need to be factored into the equation?
It helps to break them down. The biggest known risk is probably trade-related, potential tariff hikes, especially impacting that 20% of titanium coming from China. That could realistically add 5% to 10% to the material costs. The key unknown risk is some kind of geopolitical black swan event, maybe a major escalation over Taiwan that could severely disrupt global titanium supply chains. That's harder to quantify.
What about rising interest rates?
Rising rates do increase their borrowing costs on existing debt, that's true. But their massive free cash flow provides a very substantial cushion. It allows them to keep funding capital projects without having to issue more shares and dilute existing owners.
Okay, this whole analysis logically leads us to the final piece, the valuation. The stock's around $242 right now after a big 66% run-up this year, clearly fueled by defense excitement. Is that premium price justified by the quality of the materials and the seemingly locked-in growth?
This is exactly where you need to carefully weigh the different perspectives to establish your own margin of safety. Let's start presenting the strongest arguments against the current price, the bear case. Institutional analysts like Moody's do point to the company's historical cyclicality, even with the defense focus. And they did have that minor 5% overall revenue dip last year. Also, that price-to-earnings ratio, around 32 times, is definitely high compared to peers who average closer to 20 times. It suggests the market has already priced in a lot of future success. And there's a real risk that China could dump standard specialty alloys onto the market, which could potentially squeeze margins by maybe 10%.
Right, that's the cautionary view. Now let's build the strongest bull case. What justifies paying that premium?
The bull case hinges heavily on forward-looking certainty. Analyst sentiment is quite positive. Some major firms, like BTI, have price targets up around $305. They believe that 25% CAGR growth target is achievable. More importantly, the current geopolitical climate. The ongoing tensions involving Ukraine. Taiwan seems to almost guarantee high levels of defense spending for the foreseeable future. That validates the company's huge backlog. Our own internal discounted cash flow modeling, which tries to factor in the value of those proprietary alloys and locked-in growth, suggests a fair value closer to $281 per share.
Okay, so if the current market price is around $242 and your bull case intrinsic value calculation puts it near $281, that suggests the stock might be trading, about 14% below that potential value, making it potentially attractive if you buy into the overall strategic thesis. Let's bring it home, the final verdict. Let's answer that core question we started with. Are these specialty alloys truly the indispensable, unbreakable backbone of tomorrow's tech robots and weapons?
Unequivocally, yes. And that's not just marketing hype. It's a conclusion forged over 135 years of metallurgical leadership and patented processes. Their advanced nickel, cobalt, titanium alloys, They enable things that were impossible before. Drones that can withstand the stresses of Mach 5 flight, robotic exoskeletons that absorb huge impacts, railguns firing projectiles at 7,000 miles per hour without the barrel melting.
And the numbers back it up. Over 60% of that nearly $3 billion in revenue last year came directly from aerospace and defense. That $500 million backlog locks in demand for years. And those high barriers to entry, the military certifications, the proprietary VIM and V-layer processes, they create a protective moat that competitors just find incredibly difficult and expensive to cross.
The fundamental truth here is physics. The atomic bonds in these alloys are incredibly strong under extreme heat and G-forces. That's physics working for defense technology. Cheaper composite materials or standard metals, they just can't offer the same reliability. They'd fail or crack under the sustained stress these systems endure. They are, in many cases, simply irreplaceable.
So for you, the listener, the individual investor trying to navigate this, there are two key indicators you can easily track in their future reports or earnings calls. The first is defense utilization rates. Right now, they're running high, about 85%. If you see that spiked up towards 95%, that's a strong signal that a wave of new high-priority contracts for robotics and advanced weapons is flooding in. That could be a leading indicator for significant value uplift, potentially 20% or more, regardless of broader market moves.
And the second specific thing to watch is the progress they report on their nitinol research and development. Remember that shape memory alloy? It's being developed specifically for adaptive next-generation weapon systems. This kind of a stealth catalyst aimed squarely at the DoD's massive $50 billion market for AI-enabled weapons. They filed patents in 2025 suggesting efficiency gains that could genuinely revolutionize robot agility and resilience. Success there would give them a huge defensible edge for years to come. Maybe a final thought for you to chew on. In this emerging multipolar world where major powers are constantly jostling for position, nations aren't just stockpiling gold anymore. They're strategically hoarding the specialized metals absolutely required to build and arm the arsenals of tomorrow. This company's unique control over the entire production chain, from melting the raw elements to producing the specialized powder for 3D printing robotic limbs, essentially means its owners get first claim on the very sinews that bind advanced electronics to lethal capability on the battlefield.
That's the critical takeaway we hope you grasp. While software might dictate tactics in future battles, the underlying materials will ultimately determine who wins the wars. Understanding this hidden, specialized backbone of tomorrow's defense infrastructure is precisely how you can gain a real strategic edge in your own investment thinking.
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.